Okay, welcome back. Basically, you've got the market, which is up, 15 points. It's flat on the Nifty. And I think you've got the Sensex, which is not doing very much. Large caps, by the way, quieter. But broader markets are doing just fine. Rupen Rajguru is with us, Head of Equity Investment and Strategy at Julius Baer. Rupen, good to have you with us here. Thanks for your time. We had a slew of numbers over the last 3 days, post-Friday till now. What has caught your eye, and what, to your mind, deserves a bit of a re-rating, deserves a bit of a move, trading-wise or otherwise? Bandhan, for example, is seeing a big move. You got a few others like PNB, which are seeing large rallies. What caught your eye?
Yeah, hi. Afternoon, Prashant. Before I get into that, we have to acknowledge the fact that we are in a bull market. So any small catalyst can lead to a very high or disproportionate movement in the stock price. Having said that, in fact, this entire quarterly numbers, if you look through, what we believe that the pace of earnings growth, which has been phenomenal for last 4 years, which was upwards of 20% compounding for Nifty, is definitely slowing down. And we have to be cognizant of that fact. Having said that, what we are seeing is, while it's very difficult to pinpoint a unique theme which has emerged, because I think a lot of corporates are yet to announce their numbers. But some of the companies, especially say companies in the insurance side or in the IT side, what is happening is that there are incremental, some positive catalysts which we are witnessing in the on the results, as well as also in the management commentary, and hence we are seeing some bit of re-rating, or I would say some bit of mean reversion happening into those sectors. I think still early days. I think banking and financial as a whole, the commentary is okay. NIM compression is manageable, and so far no complaints as such.
Earnings from the banks have been mixed, right? Rupen, afternoon. You've had misses from Kotak, you've had a miss from HDFC. I mean, average performance from HDFC Bank. But on the other hand, ICICI Bank has been a solid set of numbers. And then some of the PSUs like PNB have backed it up. And now there is increasingly conversation on even the asset quality on the unsecured loans. Credit costs for some banks has gone up. So the picture is a bit mixed. What is the earnings visibility on banks going forward?
Yeah, afternoon, Rima. From a banking and financials perspective, and specifically in bank, and I would break it up into public sector as well as private sector banks. So you are right. Some of the private sector banks have probably, on the slippages count, they have been a slight disappointment. But at an aggregate level, as we speak, the entire private sector, and even if I were to include public sector bank, the credit costs are at its lowest. So here, I would say the RBI also, time and again, they have come out with various regulations which are kind of sounding off that they are not very happy with the kind of credit growth which we are witnessing, especially in the unsecured side. So net, I would say from a banking perspective, and I think that is also reflecting in the banking stock prices, as a whole, we believe that still private sector banks, the large private sector banks, are better placed, while public sector banks' numbers might be good, but we believe the best of credit cost is now behind us. Incrementally going ahead, not necessarily in this quarter, but the credit cost will, which has been unusually lower for them as compared to their historical average, will kind of inch up. And plus, more and more regulatory requirement will be there, moving towards ECL. Also, some higher provisioning on standard assets on project financing and all will impact public sector more than private sector banks. So net, we believe from here on, between the two, private sector banks are better off vis-a-vis public sector banks.
Okay, all right. Hi, Rupen. Good afternoon. It's a while, I think, since we chatted, but good to see you in. Well, there are two sectors that I'm looking at. One is cement, because that's my core beat, and there's a lot of consolidation going on there. But it appears you're on the side that believes in the near term that could be pain. Longer term, all this consolidation talk will help. And the other one I'm looking at is autos. You have Ola Electric that's coming out with the IPO. But you're cautious on both these two sectors. Give us a few points on why.
Sure. Yeah. Hi, afternoon, Nigel. So cement is a very interesting play. In fact, the largest cement player is operating at 90% plus capacity. And on an average, the cement sector is operating at 85-90% capacity utilization. Despite that, we have seen the prices being soft. For last 2 quarters, if I were to sum up, the prices are down around 5 to 6%. So what does that indicate? The heightened competitive intensity. And that is here to stay. And in fact, the erstwhile or the so-called disruptor hasn't even increased their capacity utilization. So the largest incumbent is clearly doing a lot of M&A, and also the second largest player. So net, to answer your question, because of the lower realization, in fact, earlier a quarter back, we were penciling that the margin trajectory of cement companies would be higher this quarter. But because of quarter one also prices have been soft, so the overall EBITDA per ton for cement companies will go down. In fact, this quarter, will be below 1,950 at an industry level. So quarter one and quarter two, the EBITDA per ton still will be lower, and in second half onwards, we might again see it inching up higher. So to answer your question, tactically, for next 1-2 quarters, we are cautious on cement, but the M&A play would be there. So any companies which are less than $100 per ton, if they are a takeover target, you might see an action out there. So it's very difficult to pinpoint which would be there. But those companies will be in foray, and those companies will see some stock price momentum. But over next 2-3 years perspective, we are constructive on that sector. But in the near term, as I said, the earnings will be disappointing for quarter one and probably in quarter two as well. Moving to auto, for last 6 quarters in a row have seen phenomenal results, and overall they are we have also seen a margin expansion story also happening through volume growth also coming through. In fact, this quarter also the earnings growth for an auto sector per se will be upwards of 15%, but the rate of growth will be the lowest which we have seen in last 4-5 quarters. And I think the only reason why we are cautious or on that sector is because there is hardly any scope of re-rating. All the sectors, all the stocks are valued to perfection. While the IPO, as you rightly said, one of the electric two-wheeler, largest electric two-wheeler IPO is there probably next week, and in few months we will see also one of the largest IPO Hyundai hitting the street, so which will keep some excitement. But I think on valuation from here on we don't see a big upside. So probably in the near term we would want the stock prices to see some kind of if not price correction, at least time correction for 1 or 2 quarters before we get constructive with that.
Right. Rupen, just stay on with us. I know that power is a sector that you like, and we want to know more about that, 120% thereabouts. So now, Rupen, let's come to your rationale behind why you still like power. What segment of it are you looking to play? And how do you find valuations now?
Yeah, hi, afternoon, Surbi. So power as a sector, again, it's a long cyclical sector, and what we witnessed between say 2008 and 2015, in which a lot of new capacity got added, but the demand was not higher, so supply was much higher than the demand, which led to probably into 16, 17 the utilization of a lot of the thermal powers went down to as low as 50-55% on the PLF side, and majority of the capacity addition happened in the renewables post that. So what happened in last 2 years, we have seen that entire trend reversing, wherein the demand has gone up and the supply, especially on the thermal side, was hardly 3-4%, and demand growth was 6-7%. So there was a clear dearth of the power which we are witnessing in India, and hence we are again seeing a gush of new investments also in the thermal side along with the renewable side. So the entire value chain, if you recollect in the previous cycle, the entire value chain got benefited, and that is exactly what we are seeing right now. So starting with the utilities to also the companies which are into the T&D side, players who do BTG, EPC, some of the companies which are into transformers, all are seeing order book being kind of full. So the entire value chain is and that's reflected in numbers as well. They all are declaring very strong numbers. Plus the financiers also are doing well. So net, yes, the big question now is valuation, because everything is getting reflected. But still, I would say on the utility side, companies has gone up. Their valuation now are at say 15 to 18 times multiple on the price to earnings, and say around 2 times price to book. But we'll have around 12-13% easily growth visibility for next 4 to 5 years. So they are kind of valued fully, but still, I would say in a market where growth is not necessarily happening across the board, these kind of themes where the growth is still strong and visible with the regulated equity, especially on the utility side, they look pretty interesting. Yes, we have to be mindful that the return expectation has to be much lower than what we have witnessed in last 2 years.
Rupen, can you tell us what have you guys bought into last? Incrementally, what have you added in?
So, hi Prashant, I'll refrain from getting into individual stocks. But as I had mentioned last time around, as a segment which we like, is the general insurance segment where we have added exposure, as well as some of the capital market intermediaries is something which we have been liking and which we have been adding for last few quarters or so. So these are some of the themes in which we have increased our exposure.
All right. Actually, ICICI Lombard, apart from the life insurers, is actually out of insurers, life and general, Lombard has seen the highest amount of earnings upgrades in this quarter across the board. So that stands out purely from an earnings standpoint. Stocks also, I think, done well from the time the earnings season started. So 1970 on ICICI Lombard. Okay, the market's down about 30, 32 odd points or so. Rupen, great to have you with us here. Thank you very much for your time. Appreciate it. We'll take a quick commercial break here. We come back with what's happening in dealing rooms on D Street Chatter with Nimesh. We'll get you some technical trading ideas as well. That's coming up.
Thank you for watching CNBC TV 18 and do follow us on all our social media platforms for news, updates and more.